Imagine you bought $50,000 of shares, property or crypto and later sold for $80,000 after holding it just over a year. According to the ATO, you can legally cut that $30,000 gain down to $15,000 using the 50% CGT discount. Yet many investors never claim it and pay tax on the full amount. The headline number here is the 50% CGT discount, which the ATO and Income Tax Assessment Act 1997, Section 115(100) grants to individuals and trusts who hold a CGT asset for at least 12 months. That single rule effectively halves the taxable portion of your capital gain on shares, investment property and crypto. Here is why getting this wrong costs real money. The ATO defines capital gains tax as the tax on profits from disposing of assets including property, shares and crypto, but it is not a separate flat tax. Your gain is added to your assessable income and taxed at your marginal rate, so an extra $20,000 gain can push more of your income into a higher bracket and lift your total tax bill significantly. Take a crypto example using a 37% marginal rate. Buy at $20,000 and sell at $40,000 for a $20,000 gain. Sell at 8 months and you pay roughly $7,400 in tax. But sell at 13 months and the 50% discount cuts that to about $3,700. Waiting 5 extra months saves around $3,700 on the exact same economic gain. Step 1 is to audit your holding periods. Log into MyGov, link the ATO online service and go to your tax return under the capital gains or losses label. For each parcel of shares, your property and every crypto asset, note the acquisition date and the actual or intended disposal date, then confirm whether the gap is at least 12 months so you know which disposals qualify for the discount. Step 2 is to plan with official tools. Use the ATO's CGT calculator and record-keeping tool to model your taxable gain both with and without the 50% discount, especially for any gain over $10,000. For a property bought at $650,000 and sold at $820,000, the ATO rules mean a $170,000 gain becomes just $85,000 after the discount, roughly halving the tax. On that property gain, the difference is enormous. According to the ATO's rules, reporting the full $170,000 as taxable would cost roughly $62,900 at a 37% rate, while correctly applying the 50% discount on $85,000 costs about $31,450. That is an extra $31,450 saved simply by knowing the discount applies to property. Step 3 is to capture every capital loss, because the ATO only lets you offset losses against capital gains, never against your salary. Gather transaction records for shares, property and crypto, enter each disposal into the ATO CGT calculator and list losses at label 18 so they reduce your gains. A missed $10,000 capital loss that could have offset a future $10,000 gain wastes roughly $3,450 at a 34.5% rate, according to the ATO. Step 4 is correct classification, which trips up most crypto holders. The ATO treats crypto as property and a CGT asset when held as an investment, so disposals are CGT events, but rewards from mining, staking or airdrops are ordinary income at their AUD market value when received, and crypto spent on personal goods under $10,000 and not held as an investment may be a personal use asset that is exempt, so segment your history carefully to avoid double taxing yourself. Here is the double tax trap in numbers. If you stake crypto and receive $5,000 of rewards, that $5,000 is ordinary income at receipt, and only the gain above that cost base is later a capital gain. Reporting the full $7,500 sale as income plus a $2,500 capital gain double counts that amount, adding roughly $862 of unnecessary tax at a 34.5% rate. Before we recap, watch for 3 common mistakes. People sell shares at 11 months and forfeit the discount. They wrongly assume property is excluded and pay double, and they fail to track crypto losses. For our investor Alex, offsetting a $7,000 crypto loss against a $10,000 share gain cut the taxable amount to $3,000, saving about $2,590 in that year according to the ATO's rules. Combine all three moves and the impact is striking. For an investor like Alex, correctly timing share sales saves $2,220. Applying the property discount saves $31,450. And offsetting the crypto loss saves $2,590 for about $36,260 in a single active year. Repeat that kind of mistake even once every 5 years over a 30-year career, and you could lose well over $200,000. Let us run through the checklist. Remember CGT stacks on top of your income at your marginal rate. Audit your holding periods in MyGov. Model each disposal with and without the discount in the ATO calculator. Record every capital loss so it offsets your gains, and split your crypto into income, capital, and personal use streams. Get those 5 right and you keep thousands that would otherwise go to tax. If this helped you make sense of capital gains tax, subscribe so you never miss a plain English breakdown of the rules that quietly cost Australians money. Next up, we are walking through exactly how the main residence exemption works on property, including the 6-year rule that can keep your home tax-free even after you move out.